Hi, I'm Dr. Patty Hatfield, and I'm here to talk to you about the income statement and the cash flow statement. So we will go ahead and begin first with the income statement. So this is a true story. What would you do? Paramount Pictures agreed to let Winston Groom, who was the author of the book Forrest Gump, to choose between taking a flat $250,000 in compensation or 3% of the net income from the film. So if you were in Winston Groom's place, which would you prefer? Would you take the $250,000 and run with it, or would you take the 3% of the net income of the film? Now we have the benefit of hindsight, so we know that the film actually broke box office records, but Winston Groom doesn't know this yet. Okay, so try to put yourself in his position, and really the only information he has is that Tom Hanks is kind of behind this, and Tom Hanks was starting, to become a bigger star back then, and wanted to do the starring role in the film. So give you a moment to make your choice, and so you can go ahead and think to yourself what you'd rather do. For those of you that picked the $250,000 lump sum, that was an excellent choice. A lot of people, though, when I do this in class, will pick the 3% of net income. And that's exactly what Winston Groom did, so you're in good company. And guess how much Winston Groom made? He made zero. And how did he make zero? Because even though it was a blockbuster hit and broke box office records, the accounting that's used, particularly in creative production, also tends to use what we call creative accounting. And it literally showed the movie having a net loss, which is really kind of crazy, and one of the reasons I stay away from investing in studios. But what ended up happening, like I said, is he got nothing. So of course he sued in court, and then he did end up winning in court and was given some undisclosed amount, which I think since has been disclosed if you want to look it up, but he did end up getting his fair share of money. What's the moral of this story? The moral of this story is that if you're ever going to negotiate on an income statement, negotiate at the top of the income statement, like at revenues or sales, and never at the bottom, because the farther you move down the income statement, the more accounting plays could be made if someone is looking to try to slight you. So that's the moral of that story. We have the entire income statement for BMC Incorporated, and again you have the 3 years worth, and the income statement again will end at the same time that the balance sheet does. For BMC, I don't have it up there, but it would end on December 31st. It's a year-end statement. Actually, I can make it end whatever. Like I said, this is a fictional company. And so you look at this and you can see these are the major parts of an income statement. The income statement you're looking at in your annual report may be more detailed than this. It's very possible, but these are the major components that you generally see. I did have BMC have their own financial subsidiary. I did that because there's a number of public companies that have their own financial subsidiaries, and it does make the income statement slightly bit more complicated. If a company like General Motors or Ford, many others, if they have their own financial subsidiary attached to it, then there's certain accounts that have to be mentioned in the income statement that are specific just to the financial subsidiary. So for example, if we look at 2018, sales, the first number of sales that you see there is really made up of two components. You've got your sales from BMC Incorporated, which is the $18 billion, because these numbers are in millions. So $18 billion. And then in addition to that, we have revenue that came in from our financial subsidiary of $815 million. So, you know, we see the subsidiary does make money for us, but not nearly as much. And so you want to kind of separate that out and see how much is coming from the financial subsidiary and how much is coming from BMC Incorporated. And so total revenue is $18.9 billion. Then next, we have our cost of sales. And so again, I've got it broken out between BMC Incorporated, which their cost of goods sold or cost of sales, like I said, different terminology might be used with different companies, but the accounts are the same. Cost of sales is $13.3 billion. This is a manufacturing firm, so your cost of sales is high. Retail firm, it can also be considerably high. You know, it just kind of depends on the type of firm. So $13.3 billion is your cost of sales, and then the cost of sales for the financial subsidiary is basically interest payments they had to make to investors that, you know, place their money in accounts there, and so that would be $373 million. So our total cost of sales is $13.7 billion. And again, you see that financial subsidiaries is a very, very small portion of that. So if we take our total revenue of $18.9 billion and subtract our total cost of sales of $13.7 billion, then we are left with gross profit of a little over $5 billion. Okay. So then next, we want to take out what oftentimes is called overhead, which is your selling, general, and administrative expenses. So, you know, administrative, overhead, management, selling would be your marketing expenses. You want to take all those out, and generally they're lumped together, but some firms will do them separately, and you'll see it also as a separate item for financial subsidiaries. So the total SG&A, selling, general, administrative, is $2.2 billion. Okay, then this company has research and development expenses, which is taken out next at $528 million. Now, one thing I want to point out here, because BMC is a manufacturer, research and development is expensed. And see, this is where you can get different accounting treatments, because if you take a firm, for example, like Microsoft, think about their entire capital investment is research and development, right? You know, they don't manufacture large equipment or anything like that. So research and development costs for them would be a huge, huge expense. It would be more equivalent to BMC's equipment expense. You know, it's their equipment expense. Their equipment makes the product that drives the profit. Well, for Microsoft, the research and development drives the product, which is the software that results from the R&D. So what I'm getting at is research and development might be amortized for some companies, like a Microsoft, but it's going to be expensed for other companies where it's not their primary investment. Does that make sense? So, so for BMC, it is an expense. So now we take total SG&A of $2.2 billion, subtract from that our research and development cost, and we get total indirect operating expense of $2.7 billion. And then when you subtract your total indirect operating expense from your gross profit, then we end up with net operating income of $2.4 million. Next, we want to, if we have any interest expense, if we have any debt outstanding, we'll have to pay interest on that. So next we would want to pay our interest expense of $219 million. So we subtract that. And then you can add in maybe some other income. This might be other investment income. It could possibly be from the sale of securities. If it's substantial, there will be or should be a financial note that tells you what that other income is, so you kind of get an idea. And so that leaves you earnings before taxes, because what I'm doing there is I took my net operating income of $2.4 billion, and then I subtracted my interest expense, but I added in my other income. And so I have earnings before taxes of $2.4 billion. Then next I subtracted my taxes that I paid, and then any equity that this company received from unconsolidated subsidiaries. So in other words, they might be invested in other subsidiaries, but they have less than 50% ownership. And if that's the case, then any equity that we got from the unconsolidated subsidiaries would be added in here, and we end up with the total net profit or earnings after taxes or net income. It goes by a variety of names of $1.6 billion. So the income statement is really, really straightforward. And, like I said, you'll usually see more accounts than this, but this is the general makeup of an income statement. Now next I want to get into the cash flow statement, but I like this diagram because it does show it kind of gives you a good conceptualization of what the cash flow statement is doing. What it does is it divides all the accounts from the balance sheet and the income statement. Okay, you're taking all the same accounts from the balance sheet and the income statement, and you're dividing it into accounts that relate directly to operations, okay, which would be your net income, your inventories, your wages, your accounts receivables, those types of things. Then the accounts that result strictly from investing activities of management, and then accounts that result from financing activities. And what you're trying to do is, in the statement, is the point of the statement is to show how much cash is actually derived from the operations of the firm, okay, and you want that to be as high as possible. And then how much cash is being derived from investments, and that could be positive or negative, because if they've invested a lot in capital, they could be growing and making a lot of capital expenditures, so you could have negative investment, and that's not necessarily a bad thing. It can be a positive thing. And then the third category is financing issues. And so, what cash did they receive as a result of financing? And in finance, we're actually less interested in that third category. We're more interested in seeing, okay, how much cash did the company itself actually generate? How much was generated because of the operations of the company? How much was generated because of management's investing activities? The financing stuff has to kind of be paid back, right? If we take a loan, we got to pay the loan back. So we're not so interested in that, really. We really want to focus on the other two. And one definition of free cash flow, free cash flow is a term that's really abused. It means so many different things to different people. But one definition of free cash flow is cash flow from operations plus cash flow from investing activities. And you sum those first two categories up. And in the long run, some of those two have to be positive in order for a company to survive. But ultimately, the check is that the final number that you get from your cash flow statement should reflect the change in the cash account on your balance sheet. Okay, so let's go ahead and look at the cash flow statement for BMC. So, so here I just tried to give you some examples. So for operating activities, before we get into BMC, for operating activities, it includes the cash effects such as, and these are just examples, and they're going to, there's going to be more for different firms. But cash inflow would be a result of, selling a good or service, getting interest on a loan. If we receive dividends on security investments we've made. Now that also brings up another topic, which is not all firms will categorize all accounts in the same category. So like return on equity securities, a lot of firms might actually put that under investing activities. But if they're putting it here under cash inflow for operating activities, that means it is because it's part of the major firm, and that would be coming from both of those, the return on loans and the return on equity securities would be coming from the financial subsidiary. So that's why it's an operating activity for this firm. Okay. Cash outflows would be, we have to pay our employees, we've got to pay our accounts payable, that's the acquisitions of inventory, we have to pay taxes, we have to pay interest expense, and just any other expenses. Investing activities. So we have cash inflows that come from receipts from loans collected. And again, keep in mind this is the investing activities of management. Sales of debt or equity securities. So if they sell bonds or sell more common stock, then we get the money. So for investing activities, that would include lending and collecting money and acquiring and selling investments in long-term assets. So you can get cash inflows from receipts from loans that were collected, sales of debt or equity securities of other corporations. Okay, so it's where you're investing in other corporations. We're not financing ours. Then also, if we sell any property, plant, or equipment, that would be another example. Cash outflows would be loans to other entities, generally within the organization, investment in debt or equity securities of other entities. And again, that could be, actually I said within, it could be within or outside of our organization. The purchase of property, plant, and equipment, that's usually the biggest investing activity that you'll see, especially if it's a manufacturing firm. And then, for a retail firm, it could be certainly in terms of, like property. But sometimes they lease the property rather than purchase it. But if they do a capital lease, then that, qualifies as a purchase. Financing activities, cash inflows come from the sale of like BMC's securities. So this is if BMC sold extra stock in order to get money, or if they sold BMC bonds in order to get money. Sale of mortgages, sale of notes. Notes are usually can be short-term or long-term. Any other type of short-term or long-term borrowing. Cash outflows in financing activities would include payment of dividends. That's a cash outflow to our shareholders. If we do treasury stock, reacquire our own stock, that's also an outflow. And when we pay back what we borrowed, whether it's bonds, or it could even be a bank loan, but most borrowing for corporations are done through bonds. Okay, so now we'll see the numbers. And so you'll see here for BMC Incorporated, and again, I'll just focus on 2018. We start with net income, or earnings after taxes, and now we add back in our depreciation, because depreciation is really not a cash outflow. Yet we took it out of our income statement. You didn't see, it was listed under, it would be listed under your cost of goods sold or your SG&A, but it's not really, no one writes a check for depreciation. So since it really doesn't represent a cash outflow, we go ahead and add it back in. So we have that 1.6 billion and we add in 738 million. Now to look at these other accounts, we see accounts receivables has a negative, the brackets mean, or parentheses mean a negative $769 million. Okay, what do we mean by that? What that's saying is our accounts receivables is a $769 million drain on cash. So in other words, if you go to the balance sheet and you look at the account in 2018, you'll see that accounts receivables increased by $769 million between 2017 and 2018. Okay, so in other words, another way to state that is we now have $769 million more money tied up in accounts receivables than we did before. Okay, so it is a drain on cash. Does that make sense? We'll eventually collect it, which will be nice, but right now, it's our cash tied up in receivables there. Same way with accounting. I'm sorry, not accounting, inventory. Same way with inventory. We see that inventory is a negative $381 million. So that means we have $381 million more tied up in inventory in 2018. So if you look back in the balance sheet between 2017 and 2018, you'll see that inventory actually increased by $381 million. And so on down the line. Refundable taxes increased apparently by $150 million, so that's a drain on cash. Prepaid expenses increased by $76 million, so that's a drain on cash. Accounts payable, now keep in mind that's a liability. The first four that we talked about were assets, current assets. This is a current liability. So accounts payable shows that we do have an increase in the accounts payable account of $500 million, but that's positive to cash because that means our suppliers have loaned us an extra $500 million, right? Accrued wages, again, that account has increased by $118 million, which means we're hanging on right now to $118 million more in cash. That's just simply because of when the books closed. That's where the accrual adjustments take place. So that doesn't really, it's not very meaningful. Same way with accrued dividends and accrued taxes. The current portion of long-term debt, that's the portion of long-term debt that's due within the next year. It's actually a drain on cash of $38 million. Okay, so that increased by $38 million. So you total all that up, we get cash flow from operations of $1.8 billion. That's great. We got a good, strong, positive cash flow from operations. And then in 2017, you see it's also a positive $1.1 billion. Oops. And then in 2016, that needs to be widened so we can see what that was there. But anyway, we can see the results from 2017, 2018, and see that it's positive. So that's good. Okay, what about investing activities? Okay, good. You can see all 3 years here. I'll give you the final numbers hopefully here at the end. So for net property, plant, and equipment, again, we see that we had an increase in that account from 2017 to 2018 of 291 million. So that's a drain on cash. There's our depreciation adjustment again, because net property, plant, and equipment is based on book value, right? So we want to put that depreciation back in. Goodwill changed by $5 or $5 million. Intangibles was a $50 million drain on cash, and when you total that up, cash flow from investments came to a negative $1.7 million. So, or $1.7 billion. Okay, and so that we see the biggest chunk of that was net property, plant, and equipment, which makes sense. So again, is that bad? Not if they're gearing up for growth. If they're gearing up for growth, which really, if you look at all the accounts so far, indicates that this company is growing, that's actually a good thing. So it's an investment that's going to pay off later. And so they've been growing. They've been investing more into the company for the last 3 years. Cash flow from financing, like I said, this is the one that we're least worried about, because this is really coming more from outside sources, and like I said, it either has to be paid back or we have to offer a rate of return if it's stock. So we do end up, when you look at all the different sources of money that can come in through financing, you've got short-term debt, long-term debt, indirectly deferred income tax, being able to defer your income taxes, also indirectly your post-employment liability change from year to year. Common stock is a direct financing charge. Retained earnings is also direct. Your net income adjustment is in there because you have to account for your net income as well when you're looking at the financing portion of this. Your foreign currency translation, that was the money that we either make or lose as a result of translating currency from one country to another, and we made money. But this is looking at financing, so it's looking at the negatives. So since we made money, it looks positive. Just like with net income, you see the net income adjustment. You're thinking, well, we had a positive net income, not negative. Right, it's positive. So it's the opposite of financing. So it feeds us cash. And then we didn't have anything for minimum pension liability adjustment. Treasury stock changed by $682 million. So total cash flow from financing came to be a negative $266 million. So it was actually a drain on cash. So in other words, if you look at that, we kind of paid off more in financing than we took in, which that could be good. Excuse me. In 2017, we actually took in more financing, $146 million. So we had a positive cash flow from financing. If you look at the last part of the cash flow statement, then that's where we kind of summarize everything together. So here we can see all the numbers. Sorry, you can see the 2016 numbers before for operations, but notice we do have positive cash flow from operations all 3 years, so that's great. We do have negatives in investments all 3 years, but again, we're going to do our research and see, and if it's a growing company, then that can be good, but they have to be careful and manage their growth appropriately. And then cash flow from financing, sometimes we borrow more and sometimes we pay more back. So when you sum those 3 totals up, operations, investment, and financing, you get the total cash flow. So for 2018 was a negative $195 million. Well, sure enough, if you were to look at the change in the cash account from 2017 to 2018, on the balance sheet, you would see that it actually decreased by $195 million. So that's what the cash flow statement does. It traces the cash throughout all the accounts through all the statements. And then if you want to know what the free cash flow is for the money, and again, that's a loosely termed free cash flow. It's the sum of your cash flow from operations plus your sum of cash flow from investment. And you want your free cash flow to be positive, as highly positive as possible. And so we see in 2018 it's a positive 71 million. 2017 it was a large negative 297 million, but that was mostly due to investing. So it did pay off, it looked like, in 2018, right? Because we had a pretty nice little increase in cash flow from operations. And then in 2016 we had a really nice free cash flow of $892 million. So I'm going to end with answering a few questions that I get about accounting standards, and that is, who exactly sets the accounting standards? And accounting standards are set by Congress. They're the ultimate authority, which is why, it was Congress that came up with Sarbanes-Oxley when we had all those scandals that happened, decades ago. But they delegate most of that responsibility to the SEC, which is the Securities and Exchange Commission. And then really one branch that helps make up the accounting principles that are used, or the accounting standards, is FASB, or the Financial Accounting Standards Board, which is made up of 7 full-time members. And the 7 full-time members are supposed to represent users of accounting information. So you'll have like a certified public accountant, a CPA, on there. You'll have a chartered financial analyst, a CFA, on there. You'll have probably a CEO, or more likely a CFO, Chief Financial Officer, on there. So, a banker, a bank president, will be on there. So all the different major groups of users of accounting information will consist of that board. And so, if a scandal occurs and they want to try to prohibit that again, then they might pass some standards, to try to prohibit that or stop that behavior. On the other hand, it might be something that, it may be determined that, shareholders would benefit if they could see this accounting information. And so then it would go through this hearing, and companies can send representatives to say whether or not they like, this particular ruling, and is it going to be too costly for them to track it? And it's kind of this system that you get feedback both ways. And so sometimes the accounting rules may start out being very strong, and then it may not even pass, and so then it's discarded, or it'll pass in a much weaker form because it just might be too difficult for a firm to track that accounting information. So it's a very political process. Okay, so given that we have generally accepted accounting principles, how is it possible for some firms, these are just your few firms that are trying to distort figures, how do they do that? And there's little tricks that companies can use, and these are just a few examples. GE has been accused, I don't know if it's true or not, but kind of looks, when you look at them historically, they were the longest running company with increasing earnings up until like 2008, 2009, when we hit that crash. And one of the accusations that were made by some analysts was that, well, GE is always increasing their earnings because if they don't make the earnings themselves by the end of the quarter, then they'll just buy, GE is so huge, they just buy up another company. And then when you buy up another company, your earnings and their earnings are combined, and sure enough, then your earnings have increased. So that's one thing that companies can do. Another one is to accelerate or delay shipments at the end of a quarterly period. So in other words, if you have already met your earnings per share this quarter and your quarter's not over yet, then what companies, and this is a pretty common practice, so this is is not considered to be bad. It's only if you do it to an extreme. But what a lot of companies will do is they'll stop shipping product, so that way they won't book it this quarter as a revenue. They'll stop shipping the product, and then they'll wait until the beginning of the next quarter and then ship the product so they can go ahead and start working towards their earnings estimate for the following quarter. Capitalizing normal operating expenses. This is something some companies will try to do, and if they get busted, it's kind of one of those gray areas in accounting that they might get penalized by the market because investors get upset because they tried to pull the wool down over their eyes, but in some cases it's minor enough that the market doesn't really react. But to give you an example, marketing expenses. Marketing expenses can either be expensed or capitalized. It just really depends on the type of marketing expense. So if it's a marketing expense that is supposed to, if it's something that was expensive and it's supposed to give you years and years of benefit, then you don't have to expense it all right away and have it hit your net income so hard. You can capitalize it over a period of years. And some companies in the past have abused that. I know AOL was one that got busted for that. And then they had abused it to the point they had to restate their earnings. And when they restated their earnings after they expensed their marketing expenses rather than capitalized, they actually went from being profitable to unprofitable for a series of years. So, I mean, it can make a big difference. So that's something, too, that you have to kind of look out for. Taking big bath write-offs. Market doesn't like that too much. A big bath write-off is when you pretty much just write off a year as being like, oh, this is a terrible year, we're just going to restructure. So generally it goes hand in hand with in a restructuring of the company. And so what companies will do usually then is set themselves up very pretty for the next year. So if they do a big bath write-off this year, what that means is they're going to have a horrible net loss this year, but the promise will be, we're doing this to get ourselves, basically to realign ourselves so that from here on out we're going to be performing great. And oftentimes when they take these big bath write-offs, they might prepay a bunch of expenses, which you should only be doing in good times, not bad times. And you might just be doing some other little things like that to try to set yourself up for a really good next year that looks better than what it actually was. Which takes me to the last point, increasing reserves in good times and drawing them down in bad. We talked about prepaid expenses was an example of that. So if they're having a really good quarter, let's go ahead and prepay some expenses so that if next quarter's not as good, we can draw down on that and make our earnings estimate. Just going to spend a couple seconds or a few seconds here on international financial reporting standards. We've been kind of promising that we're going to have this for years and years, and it just keeps getting stalled. But there are some big differences between the international reporting standards and our U.S. GAAP, and these are just a few, just to show you some. And mentioned in my previous video on the balance sheet, inventory valuation under international standards, LIFO is not permitted, even though LIFO was the most, or was and maybe is the most popular inventory valuation under US GAAP. In the US it is permitted, but now we see more firms migrating toward FIFO because of the international financial reporting standards. But these still have a long way to go. But again, I'm just showing you this as just some examples of some of the differences. So it will require some changes. Okay, so if you go to your folder in Sakai, you'll see an application problem there with a simple balance sheet and an income statement and a cash flow statement. And if you could go through and answer those questions, we'll discuss them in class next week. Thank you. Bye-bye.